Wanted to do a stock market review today and take a look at some of the things that happened last week, some of the economic indicators that are probably going to continue to drive the stock market. Now, I don't know if you caught it last night. Jerome Powell, 60 Minutes, talked about interest rates kind of bluntly a little bit. But one of the things that I've been kind of insisting over and over and over again is that this economy is actually moving along quite nicely. Interest rates from Friday's non-farm payrolls report, of course, yield went higher. I want to kind of touch on that a little bit more. We got some other economic data, but let's jump in. I'll do a stock market review for today so that you can get a good idea as to what to expect moving forward. My short answer is I see no real reason for a stock market sell-off, but I certainly see interest rates remaining higher for longer. Let's jump in. I don't watch 60 Minutes on a regular basis, so I was a little surprised when I was cruising through TikTok late last night, just trying to chill out. I saw Jerome Powell pop up. I went through and I grabbed a few little bits out of the interview that they had, and he pretty much reiterated a lot of my own thinking that the Federal Reserve is likely to keep rates higher until they hit that 2% or are on a clear pathway to 2% inflation. While we are roughly 3% on the PCE, getting to 2% is the absolute goal. They would sacrifice jobs in order to do that, to maintain credibility and to keep the economy sort of stabilized. But they don't need to even really worry about that because, as we saw on Friday, of course, the non-farm payrolls came in much higher than expected, about 50% higher than what a lot of analysts were looking for. Now, I've been saying that this is more of a flyby than it is a soft landing. And got this article out of Market Watch. Stock market investors feared no landing economy could spell trouble. So my take on that is simply this. If you want to understand what's going to happen next with the economy, what's going to drive that, take a look at personal incomes and then personal expenditures. Both of those are starting to tick upward. We did not see, despite the big increases in interest rates, we did not see the slowdown that we feared could potentially happen. Instead, we saw a little blip, and I've got some charts that'll show you that it was nothing more than a little blip in slowdown. The Biden administration pushed out a stimulus program that I think is really propelling the economy forward, keeping it from going into recession. But we're probably going to see higher interest rates for much longer because of that. It's not a bad thing. Clearly, the economy is performing. Stock markets are sitting at all-time highs. The 10-year Treasury yield, now, of course, on Friday, now I said on a video on Wednesday that I was selling TLT stock. I would do so Thursday morning. TLT stock, I woke up Thursday morning. TLT stock had moved a little bit higher. So I was able to sell from a higher point, and then it just Friday morning, of course, rolled in, and I figured that the jobs report would be strong. I had no idea it would be that strong, but I do see continued employment gains because of the economic data that I'm looking at. Given that, after the interview last night, 10-year Treasury yields pushed even higher, as you can see, back up to 4.16. I could expect we'll probably sit in a range between, say, getting close to 4.25. Probably won't see too much higher from that. And that's what I'm really kind of looking for is that with regard to TLT stock, it is probably bottomed out a little bit there. Here's a better look at the U.S. 10-year Treasury yield, the weekly chart. I don't see any real reason for the 10-year Treasury to really loosen and go below 4%. I've been saying that for some time. The market disagreed with me for a brief moment. I took advantage of that, of course, going into Friday's jobs report. I expect we'll probably see these interest rates moving higher, but not to a point where we see a sell-off like we saw in October. Not yet. We'll see how the economy drives forward, keeping a good eye towards employment. We're already at 3.66% unemployment. That's about as full employment as we could possibly imagine. It used to be that 5% was considered full employment. Here's non-farm payrolls. As you can see, we saw numbers a little bit higher than expected. that could continue for some time. The unemployment rate, of course, dropping down to 3.66. It's not exactly entirely what happened here. Some people were removed from consideration that they wanted a job and therefore were unemployed. It's one of the things that the unemployment rate kind of does. Those unemployed individuals, the number shrunk from the labor pool and it pushed the unemployment rate down to 3.66. It's not like we gained that much more. This is where I start my analysis. This is how I made that trade on Wednesday. Personal incomes. We're looking at the rate of growth of personal incomes. If it's increasing, you're going to see expenditures do exactly the same thing. Revenues for company are generated from the year-over-year growth rates from expenditures. This economy is driven by 60% of, over 70% of the economy is driven by consumers. Now, there's a little asterisk there. Government stays fairly flatline in growth. It's not really going to propel things too much, except when there's stimulus that's outside of the norm. That's the other thing, the other X factor that is driving this economy, all that stimulus money that is hitting. It could very well hit inflation if we continue to see personal expenditures moving higher. This is why I'm looking at, say, TLT stock when it rallied like it did. I said, no, it's too high. Interest rates yield has dropped too low. Here's something else that I keep a sharp eye on, M2 money supply. This is the total money supply. It's starting to tick back upward. We are a fractional banking system, and if the money supply starts to expand, that means loans have been created in a fractional economy and banking system. Because we're starting to see this kind of moving upward, this really kind of reiterates that this economy is expanding. ISM services came out, nothing really too exciting, but look for the 60 number. If we breach that, then we're looking at an economy that is performing well. Keep in mind, personal incomes, personal expenditures, we're sort of in that midline, but moving higher. ISM services will do exactly the same. What I do is I break down the S&P 500, the NASDAQ, and then the 11 sectors within the S&P 500, but I just use one share for each of the stocks in the S&P 500. I don't do the weighting. And then I look at the next 4 quarters, add them up, divide it over top of the current stock price for each stock, and that gives you yield. As you can see, S&P 500, 4.877%, just went sub 5% a couple weeks ago. We're at these lofty levels, and it could very well be that we continue to see sub 5%. There are some stocks that are buy on the dip opportunities. Other stocks are overpriced. We look no further than XLK technology sector. This is the Spider Select ETF sector stock. 3.052% is the current yield given the number of stocks in the XLK technology sector. What is likely to happen is we'll see sub 3% with some of the stocks that we've been looking at that are kind of moving higher. Now, here's the Magnificent Seven. Apple stock, Amazon stock, Alphabet stock, Meta Platforms, Microsoft, Nvidia, Tesla. And I did exactly the same thing here, just one share. What's the earnings per share projection over the next 4 quarters? Add them up, divide over the top of the current price, that gets you the yield. The overall stock market, or these Magnificent Seven, which represent anywhere from, say, 24 to 28% of the broader index, only 3.27%. Now, I've been reading a lot of people sitting there getting real worried about these particular stocks being overpriced. Some are underpriced relative to other investment opportunities. Yes, some of them are overpriced. Apple's fairly close to the 10-year treasury. You would want some kind of risk premium. There are some risks involved with Apple these days, especially if you consider, say, China. Here's a look at the S&P 500 index from today. And as you can see, Friday's number, of course, we saw the sell-off, then the big move higher, kind of mellowed out towards the end of the day. This morning's move, of course, coming off the heels of Jerome Powell's interview on 60 Minutes, bond yields shot up, stocks sold off somewhat, but then rallied to almost break even for the day. There are many stocks where the yield is below, say, the 10-year Treasury yield that you would be getting from there. A lot of those stocks may start propelling other investors to step in and try to find value. But some of those Magnificent Seven stocks, of course, are a bit pricey. We'll see how that plays out. But in the meantime, here's a good look at the weekly chart for the S&P 500. Given the pace of the economy, I don't necessarily see the S&P 500 selling off. Some stocks are overpriced. You may see some revaluation. But if the 10-year Treasury yield stays roughly, say, between 410 and 440, if it maintains that range, the S&P 500 is likely to stay within this range, and then individuals will start to buy on the dips on certain stocks, and that could propel things higher. At the same time, you might see some profit taking. But I don't see a big sell-off. This economy will drive revenues for companies, which will drive profits, which will drive the S&P 500. All else equals. Will we start to see an economy heating up a little too high? Will that drive inflation? Inflation needs to come down. Jerome Powell mentioned that he was looking for the inflation rate to sort of hit the 2% level and be on a clear pathway down there before they start reimagining where interest rates should be. But right now, I don't see any reason whatsoever that the Federal Reserve should lower interest rates. The market has been betting on this for some time, and it looks like the market was wrong on this one. Nonetheless, the S&P 500, even at these levels, should keep going higher. Wanted to take a look at TLT stock one more time here. And as you can see, on Thursday morning, TLT stock, this is the ETF against the U.S. Treasury yields, 20 plus, 20, 25, 30-year Treasury yields, shot up above 98.50. It was hitting about 98.65, 98.70. When I woke up Thursday morning, sold off. I sold 101.50 calls, and then I bought 95 puts, and that trade worked out pretty well Friday morning. I took that money pretty quickly. As an options trader, that's something that I do on a regular basis. I don't sit there and try to bat for the fences ever. If I get a 20% move on one trade, I'll take that so fast and run, it's not even funny. Because being an options trader, that's one of the things that I've learned is the time is money, and those profits can evaporate tomorrow. Given that, sure didn't see the 60 Minutes interview happening, and therefore didn't see that Jerome Powell would come in and reiterate things and send TLT stock lower. Likely, I'll actually step in and sell some puts against TLT stock probably towards the end of this week, with next week as the expiration, thinking that TLT stock will probably bottom out here and sort of stay within a range for some period of time. The volatility index barely moved, and I don't expect it to move too terribly much. Here's the put-call ratio. It's starting to slide a little bit lower, and unless we get some catalyst that would push things lower in the stock market, which I don't see that actually happening, given basically the only catalyst that could occur is last night's interview on 60 Minutes. Given that, the put-call ratio is likely to slide a little bit lower, maybe pushing down to 0.85. That would send the VIX lower. I'm likely to step in and start selling puts on the VIX. And I'll use the ETFs that I usually trade against on a regular basis. US dollar index starting to skew towards the upside, the differential. The U.S. Treasury yields are going to remain higher for longer. Other countries like Europe, the interest rates there are likely to start moving back lower as Europe is on the verge of a recession. Therefore, European money is probably going to flow into the United States to take advantage of that differential. That's an X factor. simply because international companies, as the dollar goes higher, the valuation of the revenues and profits from those international companies will come back to the United States and be lower because of a higher dollar. So that could be an X factor to keep in mind. We're already starting to see some companies kind of make mention of the fact that a stronger dollar has affected the overall balance on some of their bottom lines. Nonetheless, this is how I break things down. I look at the economy and ask the question, what's driving the economy and what will likely occur from that? And that's how I make my money when I trade stocks. If that's the kind of information you're looking for, make sure to hit that like and follow button. We'll see you in the next video.